Hey, what's going on, guys? Just been really busy this past few weeks. Haven't been able to do a video. Anyways, so look at this euro chart. The euro has been crumbling for the past year, has been down over 35% or close to that range. And the alarming part of this move to the downside is that number one, you see that this has happened within 1 year, 35% move to the downside. So if it were a slow move to the downside, it wouldn't have been an alarming aspect, but this is just one red flag that I have noticed. So if you want to put everything together, you have to look at the fact that, okay, you see the US dollar index. The dollar index is a basket of fiat-based currencies, and the largest component is the euro. The euro consists of around 58% of that total basket. So that means dollar up, obviously the euro's down, and as a result, you're going to see some pain in our exporting companies, or all these companies that have manufacturing bases overseas. So it hurts our exports, and as a result, the company's earnings via FX reserves is going to go down, right? Compared to what everyone had projected. So in the short term, this may be a negative aspect for the US stock market. And in addition, you see the potential of higher interest rates set forth by the Federal Reserve. That's what's happening with commodities right now. They're getting hammered, indicating that, hey, the dollar is strong, it will continue to be stronger for a significant amount of time. Now, that being said, we should look at the overall cycles and what some individuals who predicted this euro crash and have predicted, or have accurately predicted what's going on in the economy, we should look at what kind of conclusions they are coming with the events unfolding in Europe. I first want to look at Martin Armstrong, who has a decent grasp of the overall economy, and he has this economic confidence model, and he says that, hey, every 8.6 years, if you do the math, 8.6 times 365, let's just do that right now. 3,139 plus actually 2 days of leap year, because between 8-year cycle. So if you look at it, that's 3,141 days. What is 3141, right? That's pi. Remember pi that we learned in mathematics? Right. So you take that number, 3,141 days, divided by 1,000, that gets you to the number pi. And his theory is really, really interesting. He says that there is historical evidence, not evidence, but if you go back for like 300, 400 years, you tend to see these type of cycles. Some people may say that, hey, this is pretty much a reversion to the mean, but hey, it has to deal with time. But anyways, if you want to look at his 8.6-year cycle, the economic confidence model, in 1989, he predicted almost to the day the top in the Nikkei. In 1998, he predicted the ruble would crash and burn. It did. That was the other 3,141 day cycle. The following cycle after 1998 was the 2000 subprime crisis. Subprime really started to crack in August of 2007. Before that, a month or two in July and August, you had a Bear Stearns hedge fund blow up. And now, if you look at Martin Armstrong's next time frame, where SHTF, it's 2015.75. That's what he's projecting. Remember, past performance doesn't necessarily mean that he's going to be right this time, but looking at the law of numbers, mean reversion, whatever, he believes, based on his computer models and his study of cycles, that an event should occur right after October of 2015. And what he's talking about is a sovereign debt crisis. This looks really interesting. I mean, if you look at the euro, you see this huge move to the downside. What are these traders and smart money thinking? They're thinking that, hey, you know what? We don't know how Europe's going to unfold. So as a result of this uncertainty, we're going to bet that the euro is going to go down. As a result, dollar goes up. Now, the other question that a lot of people are not asking is what will happen in the bond markets in some of these European countries? You have to realize that, okay, some of these interest rates are artificially low, way below the market rate, like in France, Germany, etc. Now, the question is, if you have a panic, if you start to see these bail-ins, or if you start to see bankruptcies, where is this capital going to go? So this could be a matter of confidence, and this is what Armstrong believes, and that, hey, people are going to start to sell their sovereign bonds. There's going to be a bond bubble. It doesn't necessarily have to be an 18% rate for some of these bonds. It could actually be 5 to 10%. I'm not 5 to 10%. It could be 5%, 6%, 7%, whatever. It doesn't necessarily have to be high. I mean, in Japan, this is a different topic. If their 10-year went to 3 to 4%, they'd be screwed. So, putting all this together, Martin Armstrong's analysis, it wouldn't surprise me if what he's talking about came true. And then the other part, which actually scares me in thinking about it, is if the money is coming out of the bond market, where will that money go? Is it going to stay in cash? Sure, some of it's going to stay in cash. Now, where is everyone going to put their money? Are they going to put it in gold? They're going to put it in silver? They're going to put it in the stock market? Probably the knee-jerk reaction initially when the Federal Reserve raises rates, by the way, if they do raise rates, the knee-jerk reaction will be they're going to start shorting, aggressively shorting, and they're going to be in cash. But then, what if all the world starts to see liquidity come out of the bond market? Where will they go? Hey, they may just go to the stock market. They may say that, hey, you know what? We don't know where to park our money. And if you could see the last month or so, you're starting to see a lot of people that are confused. They're saying, hey, we believe market's going to go up, but then there's other camp saying that, hey, the market's going to go down. So that's what we see right now for the past few weeks, the past week or so. And what I've been saying before is that, hey, you know what, I want to short this, it's going to crash, this and that. But I wouldn't, in my opinion, I'm not telling you what to do, I don't want to aggressively short this market for a long period of time. And the reason is that maybe after a quarter or two after the Federal Reserve raises rates, if they decide to follow through on that, then I may just start to buy an index fund like the S&P index fund or one of those single levered ETFs. Just put a lot of money in that, because you know what, I don't know what this money, when it comes out of the bond market, assuming that Europe collapses or the euro goes to 80 versus the dollar, the money has to go somewhere. So the knee-jerk reaction may be going into equities, which sounds crazy, but I have to always keep my options open. So yes, I've talked about Dow 11,700 and how it runs in cycles, but if it gets to that level, 11,700, I don't see it being that low for that long. I mean, one of the cues that I've told you about is if the market has a correction, there may be a lot of people coming out of the woodwork saying, hey, guess what? I was right. The economy crashed, this and that. Federal Reserve raised rates. They were going back into a depression. Like the Harry Dents of the world, they're going to come saying, hey, guess what? Dow 5,600. If he comes out and says that, you know what? I'm just going to be buying the S&P. Not because I think the economy is strong. It's just because the capital from the bond market may just end up in equities, because no one knows where the hell to park their money. I don't see people parking their money in bonds when they're at a 30-year high, or some people say, hey, it's a 200-year high, right? So that's what I'm saying. I mean, some of these individual stocks, right? I maybe a shorting opportunity for me, maybe not now, but maybe 1.5 years from now. But once again, for a short-term trade, yeah, I believe that you could go in and out. But I'm starting to think, what if this liquidity starts to go into the stock market after a 1 quarter period or 1 quarter time frame of a correction in the stock market? This is just what's going on in my mind right now, and I'm thinking, you know what? I don't want to aggressively short. I don't want to aggressively go long at this moment, but pretty soon, if we start to see a market correction, that's when I may start to just bulk up and just start to buy the crap out of the market. But anyways, what do you guys think? Do you think the market's going to sell off? Liquidity coming from the barn market will then come, like Armstrong's predicting, and then you could see Dow going to levels that a lot of us have actually not predicted. Secondly, I just want to say one thing about Armstrong. I know some people are going to say, hey, Armstrong went to jail, this and that. All I can say about Armstrong is that, number one, he predicted the Nikkei crash, the ruble crash, and then a few years after that, he went to jail. And I did read about how he refused to sell his computer model to the CIA and also the Chinese government. And it looked like he probably pissed people at the highest level. And long story short, one individual at Goldman Sachs had this complaint, and with other few individuals as well, against him, and then he wound up in jail. And even the mainstream media says that this whole trial was really bizarre and how it went down. So what I'm deducing off of all the information that I've come off of is that he pissed people in the higher ranks of our society, and he had to pay for it. So that's how I interpreted Armstrong. I know some people are going to say, hey, the SEC or the U.S. government put him in jail. He definitely did something wrong. Well, I have to think twice before I say that he definitely did something wrong. Because his forecasting, if you look at it, you may not get the exact numbers, but from a trend perspective, he is a lot better than a lot of people that I follow. So, just saying. Anyways, leave your comments below, and I'll talk to you later. Bye.